Hello guys, so I'm going to call this video the Warren Buffett way, and it's going to be about the 9 questions that Warren Buffett asks himself before he makes any investment. So I read this in a book, and they divided the Warren Buffett strategy of investment in 9 questions, and I'm going to share this one with you. And so the first question is, does the business has a monopoly of consumers that we can identify? So my previous video was talking about the monopoly of consumers and why they are such good businesses. So if you haven't watched it, go watch it. And the monopoly of consumers is something quite good because they have a range of loyal customers that will prefer that brand from any others. So does that company that you are investing has a brand that the companies can easily identify, that the customers can easily identify, and they are loyal to that brand? So if you do, you're probably on a monopoly. You probably have a company that has a monopoly of consumers. So question number 2 is, are the results of the company good, and are they in a constant uptrend? So even if you have a company with a monopoly of consumers, the management team needs to be able to benefit from their advantage, and if they do, they are bringing profits to their shareholders. And if they don't, and if they can't take advantage from the monopoly of the consumers and the loyalty of their customers, they are not bringing value to their shareholders. So the way you can see this is by seeing the last results of the company, the last years of results, and see if they are in a constant uptrend or not. If they do, then the management team is making a good job, and if they don't, they're probably not making such a good job. So the question number 3 is a company financed in a conservative way? So like I said in the other video, the company with a monopoly of consumers, they don't need a lot of long-term debt. They don't have to make a lot of updates and new innovations for the products. They don't have to build new factories. So there is no need for a lot of long-term debt. And if you find a company with a monopoly of consumers and in their balance sheet there is a long-term debt that's pretty high, well, there's probably something wrong with it. So just for you to give you an example, the revenue of 1 year from Coca-Cola was higher than all of long-term debt that they had on their balance sheet. So this is just for you to have an idea that companies like this, they don't need to get in much debt. So the question number 4 is, does the business has a consistent high profitability of their own capital? I'm going to give you an example about this. Imagine that you want to buy a house from $200,000 and you ask a bank for a loan of $150,000, and you put $50,000 from your own pocket and you rent that house, and at the end of the year you make a revenue of $20,000. Of those 15 are expenses. So you end up with a profit of $5,000. And remember that you put from your own pocket $50,000. So your rate of return at the end of the year will be $5,000 divided by $50,000. That will be a rate of return of your own capital of 10%. So what I'm trying to get with this is that Warren Buffett looks for a constant increase of the rate of return of the own capital of the companies. So if in the first year you make 10%, it will expect you to, in the second year, you will be making 12%, in the third year 14%. It will be constantly higher. And what he does, he looks for the last 10 years of the rate of the reports of the companies, financial reports, and he will see if there is a constant uptrend or not. So the question number 5 is, does the company retain their profits? So like I said, a company with a monopoly of consumers, they don't need a lot of long-term debt, and they sell pretty much all over the world. So they have high revenues. So high revenues and not long-term debt, they have a lot of profit. Question is, and they have a lot of profit, sorry, and this means that they can invest on new profitable businesses or increase and expand their business. And what we want is companies that actually do this, and they don't commit themselves to pay a high dividends for their shareholders. This is because if you're a shareholder and the company invests their profits on new business and keep making you money, you will not be taxed on that money. But if the company pays you dividends, the government will tax you on those dividends. So what we want is companies that can make profit and they can invest the profit on new businesses. So you will keep getting money, so you will keep making more money. So let's go to question number 6, which is how much spends the company on the maintenance of their operations. So what we want is a company that can make money, can retain that money, and doesn't have to spend a lot of money on their operations. So like I said, a company, the monopoly of consumers, they don't have to make a lot of updates, a lot of developments of their products. Think about Coca-Cola. They don't have to update or develop the beverage. It's pretty much the same all over the years. They don't have to build new factories to make to make new products or to increase their operations. So what we want is companies that can make money, and can retain that money, and they don't have to spend money on constantly updating their products. Because if a company really needs to spend money on the maintenance, they will be left with no money to increase the profits of their shareholders. So this will bring us to question number 4, and this one is about the will of the company invest their profits on new businesses. So far we have a company that doesn't need a lot of long-term debt, makes really good revenues, and they have a lot of profit. And the thing is, what does the company do with these profits? And what Warren Buffett looks for is for companies that they can invest his profits in a rate of return higher than the average. So what he does, he sees the average rate of return of a specific business where a company is inserted, and he will look for the rate of return, the average rate of return. And if this company can invest the money with a higher rate of return, but the higher rate of return than the average, then he's interested, carries his attention, and he's more willing to invest. So what he's looking for is for cash cows, which is what he calls companies with a monopoly of consumers that can invest their money on other cash cows, which is on other companies with a monopoly of consumers. So these companies, if the job is well done, will be making higher and higher profits and increasing the value for their shareholders. So let's go to question number 8, and this one is how good can the company adjust their prices to inflation? Let me give you an example. Think about Coca-Cola. A Coca-Cola today, it's more expensive than it was 10 years ago. So this means that Coca-Cola can adjust their prices to the inflation. Or a Big Mac today is more expensive than a Big Mac 10 years ago. So McDonald's can adjust their prices to the inflation. And if a company can adjust their prices to inflation and still not losing revenues, this means that the profits of the company are going to be stable, are going to be in the same level. So the company will not lose money in the long run. So let's go to question number 9, and this one isn't really a question, it's more like a decision-making process. So if the company follows all of the 8 questions before, chances are that Warren Buffett is going to invest in the company. And the reason why he's investing is that because he knows that in the future the stock price of this company will reflect the true value of the company itself. So he knows that in the long run, in 10 years from now, the stock price of the company is going to be higher and higher, and with good rate of returns every year. So these are the 9 steps that Warren Buffett takes before he makes any investment. Hope you guys enjoyed it. Click subscribe for more videos, click a like button, leave a comment on the section below, and see you guys next video.